Maybe it sound.
Chapter 13, incomplete record accounting. For incomplete records, so not all businesses are just anyway. Not all businesses maintain complete accounting records. So it is not complete. It might be based on the fact that the owner of the business does not have accounting techniques or knowledge about how to prepare an account or how to prepare the financial statement. So it leaves them scattered. So here I wrote, not all businesses maintain complete accounting records. This may be because the owner has neither the desire nor the skills to keep a complete record, set of accounting records. In some cases, many figures are based on estimates, which means the trading profit being created by approximation. So most of the time, the figures we have, like provision for depreciation or provision for depreciation, or provision for irrecoverable debts, these figures are estimates. As a result of that, we might have created an account based on approximation. So that's why it is incomplete record. Do you get it?
Yeah.
So how do we prepare accounting records from incomplete records? So to prepare accounting records from incomplete records, the first thing we need to do is we need to apply all accounting knowledge in order to identify the information needed to complete that account.
Okay.
Get the point I'm making here? We want to complete that incomplete record. So to complete it, we need to apply our accounting knowledge, which means all application of accounting knowledge in order to identify the information needed to complete the account. That's the first stage. Then the second one is preparing a statement of affairs. When we talk about preparing a statement of affairs, simply we're talking about an account. A statement of affairs is a statement. So the second thing we need to do when we are preparing an accounting record, after applying accounting knowledge, is to prepare a statement of affairs account. And when we talk about statement of affairs, it simply means a statement that gives us the differences between the assets and the liabilities. That is why we call it statement of affairs. Do you get that?
Yeah.
So that means we have to find the opening balance, the opening capital, and the closing capital. Then the next thing we have to do when we are preparing an accounting records that is incomplete is to use ratios to determine revenue and the cost of sales and the gross profit.
Okay.
That's the next stage. Then the stage after that is we can also use our control account to determine revenues and purchases. You know, the control account is basically for sales control account and purchases control account.
Yeah.
And for sales control account, we are simply talking about the revenues that we've not tracked.
Yeah.
And for purchases or control account, we're talking about the purchases that we've not tracked. Then, as soon as that is done, we can use our ledger accounts to find bank and cash balances. So the ledger, for the total amount in bank, the total amount in cash, we can use our ledger to find that. That is all we need to do. Then that takes us to statement of affairs. For statement of affairs, like I said, it is a statement of assets and liabilities prepared to understand the amount in change in capital. So we need to know the net assets. And to know it, we need assets, capital, and liability. So based on our accounting information, our accounting equation, asset is capital plus liabilities, which means capital equals to asset minus liabilities. I think it's clear. So that takes us to activity 1. So are you there?
Yeah.
So for activity 1, they said LACIT has provided the following list of balances for our assets and liabilities for January 2019 to December 2019. So here we have the opening. We have our opening capital and the closing capital.
Yeah.
So the difference between the opening capital and the closing capital is our net. That's our net differences, which we're going to use. So here we have office fixtures at 3,500. So we have to pay it this way. We have our opening separately, opening capital, closing capital. So for opening capital, it's going to be assets minus liabilities, opening assets minus opening liabilities. Closing will be closing assets minus closing liabilities. That's total asset minus liabilities, total asset minus liabilities. So this is here. So I'm going to read them out. So for January 2019, we have office and fixtures, which is non-current asset, which is 3,500. We have inventory, which is 1,060. That's still opening January. Then we have trade receivables, which is 6,580. Then we have bank balance from bank statement, which is that's cash at bank, which is 8,195. The total is 19,335. That is our total assets. The liabilities for 2019 January is trade payables, which is current liabilities.
Yeah.
So that's 9,300. So 19,335 minus 9,300 gives us our opening capital.
Okay.
So our opening capital here is 10,035. Done. Then we have our closing. We need to find our closing capital. For closing capital, we have the total assets for closing, which is fixtures 3,500, inventory 1,300, trade receivables 7,345, cash at bank 210. So the total assets there is 12,355. Then we have our trade payables, which is 6,135. So total asset minus liabilities gives us our closing capital.
Okay.
So the closing capital there is 6,220. I think it's clear. The same we should find the opening capital, which is 10,035, and the closing capital, which is 6,220. Now we're told to calculate the profit for the year. Assume last set made no drawings. So profit is closing cap. The formula for profit is closing capital minus opening capital plus drawings, if we have. But here we don't have drawings, so we have closing capital minus opening capital. The closing capital is 6,220, and the opening capital is 10,035. That's more of a loss, not profit. I think it's clear.
Yeah.
So, but the value is 3,815. 3,815. So that takes us to activity 2. So for activity 2, are you there? For activity 2, they said if started the business with 18,000 of her own money. In addition, she made use of a loan of 5,000 given by her uncle. This loan was deposited into the business bank account. Using the money available, she purchased office equipment for the business. The total cost of the equipment was 10,000. So she barely used the capital she invested into the business.
Yeah.
She barely used it. So now they said what is the amount of capital in the business? So the capital is 18,000. The loan was 5,000, which has gone to the bank account. So you debit bank account.
3,000.
Hold on, 5,000. You debit bank account. You credit his uncle. You credit her uncle anyway, or his uncle later. So you credit her uncle. Then the equipment purchase was 10,000, which is an asset. So they said we should calculate the amount of our capital. The amount of our capital is 18,000 because she didn't use the amount.
Yeah.
So here I wrote, based on the case study, if capital is 18,000, she doesn't withdraw any capital, and she barely used it to purchase the asset. So she had some amount of money in the bank.
Yeah.
Then she had the 5,000 to it to purchase the equipment.
Yeah.
So she doesn't use anything. So the amount of capital she has
18,000.
is 18,000. I think it's clear.
Yeah.
The question is trickish anyway. Then activity 3. They said the following is a summary Roshan's. The following is a summary of Roshan's net assets. At 1 January 2019, he had assets of 65,000, liabilities of 11,000. So we need to find the opening net assets there. And on 31st of December 2019, the assets amounted to 83,000, liabilities to 14,000. During the year, Roshan withdrew 10,000, that is drawing. So what is the profit for the year? So first, we have to make the account out. For the January, so we have our net assets account here. We have it. So for January, so I wrote activity 3, net assets for January 2019, assets 65,000, liabilities 11,000. So the total assets there is 54,000. For that is for January opening. Then net assets for December 31. Total assets is 83,000. Liabilities 14,000. So that's 69,000. So that gives us 15,000. So the difference, the net difference is the opening as net asset minus the closing net asset minus opening, which is 15,000 minus 69,000 minus 54,000.
Yeah.
So that gives us our net difference.
Yeah.
So that is the same as closing capital minus opening.
Yeah.
So here they said we should find profit. The formula for profit, like I told you earlier, is closing capital minus opening capital plus drawing, if there's any. Without drawing, which is just going to be closing capital minus opening capital.
Yeah.
So here our closing capital is 69,000. Opening capital is 54,000. Then she had a drawing of 10,000. So 69,000 minus 54,000 is 15,000 plus 10,000. That is 25,000. So the profit for the year is 25,000. So that ends activity 1, 2, and 3. Hold on, please.